Since his inauguration, Trump and his tariffs have dominated headlines and caused a lot of the recent market volatility we've seen. The impact of tariffs will ultimately depend on how long they last and how widespread they become. In the past, we've seen that Trump has typically used tariffs as a negotiating tool, often dialing them back once deals have been achieved. And so we expect to see more of the same this time around as well. Also, if we look at businesses in the past, they've been a lot more adaptable and actually found creative ways to circumvent a lot of the tariffs. So the impact has typically been less severe than initially feared. When it comes to inflation, there's this misconception that tariffs cause inflation. But it's important to understand that inflation isn't about the absolute price level. It's about broadly rising prices economy-wide. And it's driven by too much money chasing too few goods and services, like we saw in the pandemic. So while tariffs may push up the cost of certain imports and likely shifts demand, creating winners and losers, without a surge in money supply, it won't cause sustained inflation. For markets, they tend to typically overreact in the short term on the back of tariff-related news. But over the long term, what matters most for your portfolio is earnings growth and economic resilience. With both those still firmly intact, riding out tariff-related volatility, or any market volatility really, remains the best long-term solution.
Market pullbacks are very common, but not all declines are the same. A correction is a 10 to 20% decline driven by sentiment shifts, profit-taking, or short-term uncertainty. These occur about once a year and often recover quickly, in a matter of weeks or a few months. A bear market, however, is a 20% decline tied to deeper, more persistent economic issues. Given the fundamental nature, bear markets typically last longer, around a year, and require a sustained recovery. To put this into perspective, as per the IMF, global GDP growth for 25 is forecasted at 3.3%, or nearly $3.8 trillion. For a bear market to take hold, it would require a shock, something typically unexpected markets haven't pre-priced already, that is severe enough to wipe out this projected growth. Over the past 3 months, European equities have significantly outperformed the US, marking one of the largest rotations in 2 decades. At the start of 2025, sentiment in Europe was much more pessimistic than in the US. With expectations set low, even slightly better than feared data out of Europe was enough to fuel a catch-up rally. Recently, the performance gap has widened further as sentiment has shifted significantly. Investors now see fewer downside risks in Europe. Meanwhile, US optimism has faded, with softer economic data and renewed stagflation fears, making investors the most bearish since September 2022. The recent pullback has reset US valuations, and we believe much of Europe's catch-up trade is priced in. Market rotations like this are normal, but over the long run, earnings growth will drive leadership. And on that front, the US still has the edge, with double-digit earnings growth expected in 25 versus 5 to 6% for Europe.